I don't see any reason not to keep riding this market out. You know, you saw the market drop down a little bit on Monday out of those concerns out of Cyprus, but then eventually it just really shrugged it off. You know, in the whole scheme of things, Cyprus is a really small portion of Europe. There are some concerns about the precedent that it might set, but, you know, as we said earlier, April tends to be a very strong month. You know, so far this year, hedge funds have been underperforming the market so far. So, you know, I think you might start to see some of that money come in to the long side here beginning next week, because I don't think anybody wants to be left off as we move up further next quarter.
Okay, Chris, you think we actually are going to make it all the way to 1,600 by year end?
Yeah, I think 1,600 is the number to think about. But if earnings come in a little bit above, tracking second quarter better than first quarter, a little bit above 108, we think they will. As a matter of fact, we think GDP growth is going to be better than expected, not the 2.5 to 2 that everyone expects, closer to 3, moving that 108 number closer to 110. And if you have a 15 multiple, 16 multiple on that, that pushes you above 1,600. But the real key is not this year. We're going to get into the summer. We're going to start talking about the close of 2014, somewhere there. And that's more like 1725, 1750, because earnings should go to 114.
And 1725?
1725, 1750.
Well, a lot of the naysayers don't, you know, people who say, oh, we shouldn't be up this high and this is not backed by the economy, and we're not seeing the data to support this.
They don't think that the earnings are going to be.
Earnings are at a record as well, right? I mean, that's something that just can't be denied.
Well, that's the thing. You invest in the private sector, not in the government sector. The private sector is very healthy. They could be healthier. There are some roadblocks in the way. But the fact is we are going to record profits. We've had record profits for 3 straight years. Our first all-time high was in March of 2000. The earnings number was 59. The second all-time high was October 9, 2007. The earnings number was somewhere in the mid-90s. We're now at 108. We're at the same price level, so the multiples come down. And we still have a very herd and a very large amount of money earning 0% somewhere. If we were at higher multiples, I'd be concerned. As we get higher multiples down the road and profits start to roll over and come down, that's when you go underweight equities. We're not there.
Mr. Voorhees, does this make sense to you?
Yes, it does. You know, I think this next quarter, not to sound redundant, but I think it's going to be very telling. We're going to see how some of the laggard components, you know, such as basic materials perform, which will give us a better picture of what's going on in terms of the global growth story. I mean, just this week, we did see that, you know, fourth quarter GDP, it was revised upwards. And, you know, now the forecasts here for Q1 are on the rise. So, I mean, I think this points to an improving economic picture, just in a broad sense. So, you know, if we see earnings continue to meet and exceed expectations here, I think we will see, you know, see some of those numbers.
I get someone else joining us right here with the conversation. Chris Gersh from the floor there at the CME as well. Chris, are you in agreement here? Do you think that this market's going to continue moving higher as we look at this brand new record closing high on the S&P?
I don't, and I'm really taking that from the floor. We saw very light volume right before a holiday. Traditionally, you see an upswing on the first of the month. More or less, what I think is we're the best of the worst right now. The only equity market beating us is Japan, and that's because of their easing. And I think that we're just easing just as fast, and really it's easy money. This is an inflationary rally, and I think we're going to have a nice pullback in the second quarter.
Wow. Okay, well, I'm glad that we got some a voice of a dissonant voice in here, because we had a bit of a choir saying everything's moving higher. So you think this is a market that's fueled in part by the Fed, and at some point it's going to come back to haunt us?
Yeah, yes, I do. And I think I'm just taking that from the traders, guys that I trade next to all the time. And they're just more or less, they're ready for that fallout. They're ready to hit that bid and really, you know, short sell this market. So the very light volume at this record high, it's a triple top. And I think that the fact that we're not pushing through is a big issue.
But here's the issue, right? I mean, you're saying it could happen this year. It could happen in the second half of this year. I would just say you got a Fed that's going to continue to print for the foreseeable future. So why would you be so convinced that the market would back off of that potential sugar upside that they're going to get from Mr. Bernanke?
Well, I think you hit it on the head. Everyone's on a sugar high right now, and when all the sentiment just 2 months ago, all the sentiment was bearish. We were due for that pullback. People said February wasn't enough, and now that everyone is leaning on that, we're just going to continue to go higher. That's really when you got to start looking at the market and consider taking some off the table. I would not be going long into the weekend.
All right.